You walk into a coffee shop, tap your phone on the reader, and walk out 3 seconds later with a latte in your hand. Later that day, you book a flight, pay your Netflix subscription, and split an Uber with a friend. None of it feels like anything. No paperwork, no waiting, no friction. It's the most boring part of your day. And that's exactly the point. But behind every one of those silent, sub-second moments is a sprawling network of banks, merchants, processors, and card networks moving information back and forth at extraordinary speed. And sitting quietly in the middle of that network is a company that doesn't lend you money, doesn't sell you anything, doesn't ship a single product to your door. It just stands at the intersection where money moves and quietly takes a small cut almost every time it does. So here's the question worth your next 10 minutes. How does an essentially invisible company become one of the most profitable machines on the planet? Welcome back to Boring Monopolies. Today we're talking about Visa. The first thing to clear up is that Visa is probably not the kind of company you think it is. Most people, if you ask them on the street, would tell you Visa is a credit card company. They'd say it issues cards, it lends people money, it sets your credit limit, maybe it sends you that bill at the end of the month. Almost none of that is true. Visa doesn't issue your card. Your bank does. Visa doesn't decide your credit limit. Your bank does that too. Visa isn't a bank at all, and it doesn't take on the risk that you might fail to pay back what you spent. What Visa actually is, in the simplest possible terms, is a card network. Think of it less like a lender and more like a financial highway system. Banks issue the cars. Merchants build the destinations. Processors handle the on-ramps. And Visa? Visa owns the road. Every time a transaction drives across that road, a small toll gets collected. You don't see the toll booth. You don't slow down for it. But it's there. And it's been there the entire time. That reframe changes everything about how you understand the business. Because once you see Visa as infrastructure instead of a card issuer, the real story starts to come into focus. So let's actually walk through what happens when you buy that $5 coffee, because this is where the toll booth becomes visible. There are 6 players in this drama, even though you only see one of them. There's you, the cardholder. There's the coffee shop, the merchant. There's your bank, technically called the issuing bank. There's the coffee shop's bank, the acquiring bank. There's a payment processor handling the technical plumbing. And there's Visa, the card network. Now watch how fast this moves. You tap your card. The point-of-sale terminal sends a request to the acquiring bank. The acquirer forwards that request onto Visa's network. Visa routes it to your issuing bank, which checks whether you have the funds or the credit available. The answer travels back the same way it came. The transaction is approved. The coffee shop sees a green light on the screen. You walk out with your latte. All of that, every step, happens in roughly 1 second. And here's the part that makes the business beautiful from a financial perspective. Visa typically doesn't take the biggest slice of the fees in that transaction. The issuing bank usually takes more. But Visa takes a tiny piece, and it takes that tiny piece on every single transaction that crosses its network. Anywhere in the world, every single day. That's the invisible toll booth. Nobody at the coffee shop looks at it. Nobody on the customer side feels it, but it's collecting. Transaction after transaction, in a steady, relentless drip. This is exactly why Visa fits into the Boring Monopolies series so cleanly. It's not Apple unveiling a new iPhone to a screaming auditorium. It's not Tesla launching a Cybertruck. It's not NVIDIA riding an AI wave that hits the front page every week. Visa doesn't need viral moments. It doesn't need to reinvent itself every product cycle. It sits at a layer beneath all of that, in the part of the economy nobody pays attention to until it breaks. And what makes it so durable is something economists call a two-sided network effect. Consumers want a card that's accepted everywhere. Merchants want to accept the cards that consumers carry. The more cardholders there are, the more merchants need to be in the network. The more merchants accept Visa, the more useful a Visa card becomes. Each side reinforces the other. And once that loop has been running for decades, breaking into it is borderline impossible. Because building a payment network isn't just a technical problem. It's a trust problem, a regulatory problem, a banking relationships problem, a fraud prevention problem, and a global coverage problem, all stacked on top of each other. You don't outcompete that with a clever app. Now let's talk about the part that makes this whole thing financially extraordinary, which is the math of small fees at enormous scale. A fraction of a percent on any single transaction sounds trivial. It's a rounding error. Nobody would design a business around a fee that small if it only happened occasionally. But apply that fraction to billions of transactions a day, across nearly every country on Earth, and it becomes one of the most powerful revenue engines in modern capitalism. And here's what makes it even better. Visa benefits from almost every long-term tailwind in the global economy without having to lift a finger. Consumer spending grows over time. Visa benefits. The world keeps shifting. From cash to digital payments. Visa benefits. International travel rebounds. Visa benefits. E-commerce expands. Visa benefits. The subscription economy explodes, with everyone paying monthly for streaming, software, fitness apps, and meal kits. Visa benefits. Inflation pushes prices up. The transactions get bigger, and Visa's percentage-based take goes up with them. The company doesn't have to manufacture more product, open more factories, or hire armies of new workers to capture this growth. It just has to keep the rails running. And because it doesn't take on to the credit risk that banks do, it gets to enjoy the upside of a growing payments economy without absorbing the losses when borrowers default. That's why its profit margins are stunning compared to almost any other industry. But this raises an uncomfortable question, and it's worth pausing on. If Visa is collecting a tiny fee on every transaction, who is actually paying it? Because when you tap your card, you don't see anything come out of your pocket beyond the price of the coffee. The fee feels invisible to you, the consumer. Technically, the merchant pays it. They're the ones absorbing what's called the merchant discount rate, the bundle of fees that includes Visa's cut, along with the issuing bank's interchange and the processor's charge. But merchants aren't charities. They're running a business with margins to protect. So those fees, in many cases, get baked quietly into the prices on the menu, the shelf, the website, which means the cost of running the toll booth doesn't really land on one party. It gets distributed across the entire economy, including, in many cases, customers who pay in cash and never used a Visa card to begin with. So now we have to ask the real question. Is Visa providing a genuine service that makes commerce faster, safer, and more convenient for everyone? Or is it functioning as something closer to a private tax on global trade, collected silently, paid by everyone, opted out of by no one? You can hold both ideas at once, and most honest analysts do. Which leads to a natural follow-up. If merchants are the ones writing the check, why don't they just refuse to accept Visa? Why not say no to the fee and pocket the difference? And the answer is that they've tried, and almost none of them can actually walk away. Because the moment you stop accepting cards, you start losing customers. Modern shoppers don't want to fumble with cash. They want speed. They want rewards points. They want fraud protection. They want chargeback rights when something goes wrong. And online, they basically can't pay any other way. From the merchant side, accepting cards isn't just a concession. It's also genuinely useful. Card payments clear faster than checks. They cut down on the cost and risk of handling cash. They tend to increase impulse purchases, since customers spend more freely when they're not counting bills. And if you sell anything online, refusing cards doesn't really make sense as an option at all. So even though merchants complain loudly and consistently about interchange and network fees, almost none of them actually leave. That's the signature of a well-built toll booth. The drivers grumble about the price, but the road is too important to avoid. This brings us to the deepest part of Visa's defenses, the moat that makes the whole thing so hard to disrupt. And it isn't just one wall, it's layer after layer stacked on top of each other. The first layer is the network effect we already talked about, where consumers and merchants pull each other into the system. The second is trust. Payments require near-perfect reliability, and any new network has to convince banks, merchants, and ordinary people to bet on it before it has a track record, which is almost an impossible cold start. The third is regulatory complexity. Cross-border payments touch anti-money laundering rules, data privacy laws, consumer protection regulations, and central bank oversight in every market they enter. Navigating that takes decades and an army of lawyers. The fourth is fraud prevention. Visa doesn't just pass transactions back and forth. It runs the standards, the security protocols, the dispute systems, and the constant cat and mouse game with fraudsters that keeps the whole network functional. The fifth is global acceptance, and this is the one that's really hard to replicate. The reason a Visa card is valuable is that it works almost everywhere, and you only get to almost everywhere after 30 or 40 years of grinding agreements. And the sixth is low marginal cost. Once the infrastructure exists, every additional transaction costs Visa almost nothing to process. The economics keep getting better the bigger the network gets. Stack all of that together, and you arrive at the real thesis of this whole story. The most powerful position in the modern economy isn't always owning the product. It isn't always owning the customer relationship. Sometimes it's owning the path that the money has to travel. Banks hold the money. Consumers spend the money. Merchants earn the money. Governments regulate the currency. But Visa sits at the intersection of all of them, and it doesn't have to take on any of their hard jobs. It doesn't decide what you buy. It doesn't manufacture goods. It doesn't carry the heavy credit risk that banks do. It just makes sure that when money moves, the transaction crosses its network. And this is the strangest, most counterintuitive form of power. Because the less anyone notices it, the more durable it becomes. Visa isn't selling you a ticket into the digital economy. It's the turnstile that almost everyone has to walk through to get in. Of course, no toll booth lasts forever, and it's worth being honest about the threats. Governments around the world have started pushing harder on interchange and network fees, capping them in some markets and threatening regulation in others. Merchants, especially big retailers, have been lobbying for years to bring those costs down. National real-time payment systems, like instant bank-to-bank rails in India, Brazil, and the EU, are growing fast and bypassing card networks entirely for some kinds of transfers. Fintechs and digital wallets keep promising to route around the traditional rails. Stablecoins and blockchain-based payments float the idea of moving money globally for almost nothing. And big tech players like Apple, Google, PayPal, and Block keep pushing further into the payment interface layer. So the threat is real. But here's the catch. Most of those digital wallets, when you peel them open, are still running on Visa and MasterCard rails underneath. Real-time payment systems are excellent for peer-to-peer transfers and bill payments. But they haven't yet replicated the global merchant acceptance, the rewards ecosystem, the fraud guarantees, and the chargeback protections that make cards so sticky. Habits are powerful, and the bundle Visa offers is genuinely difficult to unbundle. The empire isn't invincible, but it isn't crumbling either, which leaves us with a bigger lesson, one that goes beyond Visa. The most powerful companies in the modern economy aren't always the loudest ones. Some companies dominate by owning the user interface, the screen you stare at every day. Some dominate by owning physical assets, the factories and warehouses and chip fabs. But a rare few dominate by owning a layer of invisible infrastructure that almost everything else has to pass through. Visa turned convenience into a recurring stream of fees. It turned trust into a network effect. It turned every tiny tap and swipe into a slice of the global economic engine. So the next time you tap your card for a coffee and the whole thing feels like nothing, remember what's actually happening in that fraction of a second. A signal is racing across continents, 6 different parties are coordinating in real time, and a toll booth you'll never see is collecting its share. That's Visa. That's the boring monopoly hiding in plain sight. If you've made it this far, drop a comment with the next boring monopoly you want broken down. MasterCard is the obvious one, but I'd argue the more interesting names are companies like Moody's, S&P Global, ASML, Amadeus, Waste Management, or VeriSign. Each one quietly owns a layer of the modern economy that almost nobody talks about. Subscribe if you like watching unsexy companies get pulled apart and revealed for the giants they really are. Because in this series, we're proving the same thing over and over. The most boring businesses are very often the most powerful ones. See you in the next one.